Welcome back to Housing Income. Thanks for tuning in. Today I'm going to talk about the MSTE ETF that you clicked on. This is not the first time I am making a video on this. I discussed this fund about 6 months ago, and there was a great amount of views and response to this video. And so I thought it's a good idea to discuss this as of now because it's been in the news and a lot of developments and people talking about it, and especially the MSTR or strategy, which has fallen down or lost its stock price dramatically in the recent times. Of course, this video is not to gain more views or try to get popularity. It's mainly to reinforce the same points or concepts that I mentioned in my previous video, which was the MSTE roller coaster ride or playing with fire. Okay, so I'll quickly get into the discussion and then we'll look at the final takeaways. So, getting straight to the point, like how is strategy enhanced high income ETF? That's the name of the fund. It was launched in early 2025, and assets under management is about 380 million. So it's a decent sized fund, and the fund houses Harvest, which is known for covered call riding and income funds, and they have a good track record. Like they have diversified income funds, and they have used covered call strategy with importance given to long-term appreciation potential. So they don't just write covered calls on the entire portfolio; they write on a very small part of the portfolio. Yeah, in this case, we are dealing with one single stock, and covered calls are being written on that stock. So that's the whole um, strategy behind this fund, MSTE. So, given this fact, the management fee is 0.40, which is reasonable. However, if you look at the management expense ratio, it's pretty on the higher side, 1.89%. Given the fact that you're dealing with a single stock and covered calls, and for some people, the fee is okay because they want that higher returns or higher, potential. And there is a leverage also in this fund. I'll come to that later. Mm. So as we move on, let's look at the performance of the fund. I have done the, research on the distributions price. One thing to keep in mind, I'm not covering the MSTR or the strategy stock here. Like this discussion on the stock or the company is beyond the scope of this video, because I have limited understanding. So I'm going to discuss only about this fund. Let me get into the spreadsheet, tell you the distribution yield, price returns, and the total returns. Okay, so let me move it a little bit to the center so you can see it clearly. So if I go to the top, like I'll zoom it a little bit. If I go to the top, the current market price as of June 17 is $2.63. So that you can see it in the center of the screen. Um, if you go above, like I can just point out here on the cell 1609, $16.09 is the price 1 year ago. So 1 year ago it was like $16.09. Now it is $2.63. So basically, if you look at the price return, like the stock has lost about, not the stock, ETF has lost about 83.7%. So you can see that on the right side of the screen, the price return, like it's gone down by 83%. So minus 83.7. It's a dramatic hit for people who are holding it like since last 1 year. Um, I'm not sure if anybody watching this channel is holding this ETF. If you are, please comment below. Uh, Coming to the next area, that is the distributions. So I have the distributions mapped out here. If you look at it, like I have marked the distributions since last 12 months in yellow. So June 2025, they started with a payout of like 60 cents, and it maintained 50 cents for a couple of months and then dropped down to 55 cents, 45 cents, 35 cents, 20, 15, and so on. The bad news is, yeah, the distributions are going down. But the good news is that Harvest Portfolios is trying to be more cautious and trying to maintain the distributions at a reasonable level to preserve the net asset value rather than just randomly distributing more. But in any case, the bad news doesn't go away because the underlying stock, which is MSTR, is also falling, and that is leading to the fund, falling dramatically in recent times. So when I calculate the total distribution, that T12 distributions is about $4.10, meaning the total of 12 months distribution is $4.10. So $4.10 over 2.63, the price would give you like 155% distribution, like 155.9% distribution yield. Can you believe that it is 155.9% distribution yield? That's the yield in the last 12 months based on the current price. However, let me put it in context because this looks really, out of the ordinary and it looks like something wrong here. But when I look at the cost, let's say someone invested in the company 1 year ago. Now, what is the yield on cost? That's another thing to look at. So you get the right picture, right context. So if someone invested in this stock 1 year ago at $15 or 1609, they are sitting on a yield of about 25.5% because you're getting $4.09 on 1609. So that's 25.5%. So that's makes sense. Like 25% yield makes sense, even if you're holding since 1 year. But when you look at the total return based on the current yield, it comes to 72.2%. But if I look at the current price return plus the yield 1 year ago, like then it will be minus 58. So, people who are sitting on this ETF for a long time, they are actually losing value, like they're losing more than 50%. That's the concern that we are trying to address here. So going back to the main slides. So you have the distribution yield on 55.59%, but if you look at the yield on cost, it's 25.5. Same information, it's captured here. So you when you look at the total returns, it is again minus 83.7%. So we have already discussed that. Let's go to the next one. Now, why this is happening and what is wrong here? It can happen to any other single stock ETF. So it's not about strategy or MSTR. So this can happen to any other stock. Like if you look at the comparable returns of Bitcoin or index, then you'll know what happened. Like, but this video is not going to go into that information. We are going to find out like what is the reason this is happening. So if you look at the returns that you're getting negative returns, that's one part of the problem. But the other part is like the fund writes covered calls on 50% of the portfolio. The other 50% will capture the full upside. Okay, that's one side of the story. The other side of the story is the other 50%, which is supposed to capture the full upside, is now capturing the full downside, right? So that's where the problem is. Like you put in a lot of shock absorbers on your bike, like Harley Davidson, but now you're driving off the road into the ditch. So if you're driving on the ditch, the shock absorber is not going to help. You're going to fall and you're going to hurt yourself. That's exactly what's happening here. The active covered call is still generating income. The income is reduced because now the stock price is less, the premiums are going to reduce. That's one issue. The other big issue is the entire stock price is falling and the NAV is also falling along with it. So the, the core problem is the underlying asset has to be of high quality. If your covered call fund has to perform well. The fund is made up of the underlying assets. If you don't understand the underlying asset, that's where the problem is. So we'll get to that in a moment. So the other issue is like since this negative returns are coming in, it's also being expanded by leverage. The fund has 25% leverage, which means that any income you get, any growth you get, will be multiplied by 1.25x. So imagine if the fund is going to give you 10% returns, then leverage will imagine if the underlying asset is giving 10% returns, the fund will give you 12.5% returns, roughly. Like if the underlying asset is going to lose 10%, then the fund is going to lose 12.5%. So I hope I made that clear. Depending on the movement of the underlying asset, the fund is going to move 1.25 times in terms of the income, in terms of the growth. It may not be the exact mathematical calculation, but it's going to be somewhere around that level. Now, when the fund is going to generate um, lesser amount of premiums, again, it's going to reduce further. And when the stock price is falling, underlying stock is MSTR, it's falling. Fund is going to fall by 1.25x more. Like it's going to fall dramatically more. That's what is happening in this case. So, where do we go here? Final takeaway. I'm going to explain the takeaway point. Uh, if you don't understand a stock or a company, don't invest in that stock or call ETF. Yeah, so that's the underlying message. It sounds so simple, but I'll explain to you the logic behind it because you want to know the exact reason. I don't want to tell everybody I don't invest in the stock. Invest in a stock if you know the underlying company, underlying business model, and know it pretty well. That's where you invest in a single stock. It's not, you always have the basket of ETFs. ETF holds multiple stocks. So one stock collapsing or, falling apart, it's not going to dismantle your entire portfolio. Okay, let me explain this concept here. Let's say your portfolio has four different ETFs and you invest equally across all these four ETFs. So let's call them basket ETF 1, ETF 2, basket ETF 3, basket ETF 4. So all these four are part of your portfolio. That's your portfolio, which is your total investments. So you're putting 25% in each of them. Now, let's take an example here. Situation. The second basket ETF 2, has a risky stock. It could be MSTR, it could be some other company, Coinbase, anything, any new or fancy company that you have. And that risky stock is about 5% of the basket, of basket 2. So if the basket size is $100, this risky stock is $5 in that basket. So you understand. So what if this kind of collapse happens, like we had with MSTE? What if the original stock collapses and your fund is also collapsing according to that, or it goes to zero? Now, your basket is going to lose that 50%, and what happens to your portfolio? Try to answer this question. What will be the impact if the risky stock is completely wiped out? You lost its value, it goes to zero. What happens to your overall portfolio? What is the max loss that you are getting? Okay, I'll explain that in the next slide. So in this case, what's happening is one part of the answer question can be easily answered. Your basket is going to lose 5% because that 5% stock is going to zero, assuming everything else is doing okay, everything else is normal. Your risky stock is going to pull your basket down by 5%. That's one part of the equation. The other part, what happens to your overall portfolio, like overall investments? Since your basket is losing 5%, your basket is only quarter of the overall investments. So whatever impact you see 5%, a quarter of that is going to be the impact on the overall portfolio. So if you take a quarter of 5%, it's 1.25%, right? So your overall portfolio is losing only 1.25%. If you have a risky stock like this within an ETF, you got my point. If you had invested the risky stock in your overall portfolio, let's say you put this entire risky stock in your overall portfolio, like 25%, the entire 25% is going to be wiped out, and 25% of your portfolio is wiped out like that. It's gone like that. It could be thousands of dollars, hundreds of thousands of dollars gone like that. Okay. Now, if you had invested in the ETF, which holds a small portion in that risky stock, so the basket is hit by 5% only, and your overall portfolio is hardly hit by about 1.25%. Okay. So you understand the difference. But if you had invested like a quarter of your portfolio on this entire stock, you would have lost the entire quarter of the portfolio just like that. So that is why I'm saying once again, the final takeaway message is here. If you don't understand the stock or a company or its business model, don't invest in the stock's covered call fund or covered call ETF. Let me ask you a question here. Have you seen any single exchange traded fund on a single stock? Not a covered call fund. We have index funds, we have like sectoral funds. Have you seen one fund which is like uh, focusing on just one stock, single stock ETF, which just invest in that fund? No. The recent trend of all these single stock covered call ETF doesn't make sense to me. And I'm sure it doesn't make sense to you as well. Instead of investing in that single stock covered call, you might invest in that stock directly in the same amount of risk that you're taking. However, in some cases, if you want to add a covered call to smoothen the returns, I understand there are use cases for that. However, if you are conservative investor, you don't know the company and you don't have the bandwidth or the capacity to research or understand the company, then please don't invest in the single stock covered call ETF. Period. So I hope that message is pretty clear. And if you like this video, feel free to give it a hype or share with your friends. And happy investing. Have a great day.